Do you know what is common between the best athletes, soldiers, actors, or for that matter, exceptional performers in any field? What really separates them from others beyond their sheer skills, practice, and discipline? Welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. Here's that common trait amongst the high-performing individuals. They have a written plan that ensures they're always prepared and never caught off guard by unexpected situations. They account for literally every possibility. This is also true for all great traders that I've met who attribute a lot of their success to meticulous planning. A trading plan is a systematic method for finding and taking trades after considering factors like time frames, risk, and trading style. In today's video, we'll take a look at some key points to be kept in mind while creating your own trading plan. But here's a single-step plan to improve your crypto knowledge. Subscribe to this channel because we'll keep bringing informative content for you. With that out of the way, let's get started. First, let's talk about time frames. As a trader, you need to decide how often you'll trade and on which time frames. Will it be multiple trades a day on 5-minute charts, a few trades a week on an hourly chart, or 2-3 trades per month on daily charts? This decision depends on two things: your work schedule if you're a part-time trader, and aligning your trading style with your personality. Now you can choose intraday trading with a relaxed work schedule or 3-4 positional trades per month with a busy job. This clarity will help you maintain discipline by avoiding the temptation of trading on other time frames. The second decision involves selecting your trading techniques and tools. This includes choosing between screeners and manual token filtering on websites like CoinMarketCap to discover trading opportunities. The next step is developing your core trading strategy, which encompasses your choice of indicators, price action methods, volume analysis tools, and chart patterns. It's essentially about deciding what factors you will consider when making trades. This is based on experimentation to find what suits your trading style. For instance, I found that using multiple indicators can be a little confusing for me, so I prefer a simpler approach with support and resistance levels in my trading setup. This point builds on the previous one by focusing on trade entry and exit rules. It involves decisions such as the number of indicator confirmations required before entering a trade, criteria for re-entering profitable trades, and determining stop loss and take profit levels. Some traders prefer 2 confirmations like RSI crossing a level and a resistance breakout, while others require at least 3 confirmations. Similarly, some traders wait for the trade to reach a specific profit percentage before considering a second entry, while others take a second entry based on price crossing a particular price level. Like I mentioned at the start of the video, a good trading plan has answers to all possible scenarios. No trading plan is complete without effective risk management because losses will keep eating up all the profits that your strategy generates. This includes decisions regarding hedging your trades, position sizing, and risk-reward ratios. While some prudent traders prefer not to risk more than 1% of their capital on a trade with risk-reward of at least 1:3, more aggressive traders are comfortable risking 2 or 3% of their capital with a risk-reward of just 1:2. It is important to evaluate your own risk appetite while making these decisions instead of directly replicating what someone said on the internet. Risk management practices are arguably the most crucial aspect on this list, and I would urge you to research this properly. If you want to know more about risk management, do check out this detailed video we made on that topic. The link is in the description and also up here. Despite its importance, maintaining trading journals is one of the most overlooked aspects of creating a trading plan. A trading journal is a tool for recording and tracking your trading performance, which can later be used to learn from both profitable and losing trades. This includes deciding what you will record in your journal and what format. Commonly recorded details include the traded token's name, entry time and price, trade entry logic, trade quantity, stop loss level, initial target, exit time and price, and an analysis of what went wrong or right. Basically everything that you need to know about that trade. Previously, traders had to rely on Excel sheets for maintaining trading journals, but today various softwares automatically record and maintain trade details. However, it's not enough to just maintain your trading journal. After all, it won't analyze itself, right? You must make a weekly or monthly habit of reviewing past trades to gain insights into your successes and recurring issues with losing trades. You should also focus on identifying your most profitable time frames, assets, and indicators, as well as your biggest losers. For example, I initially believed my intraday trades were performing really well. How delusional of me. However, after several monthly reviews over a period of time, I found that most of my losses were from intraday trades involving a few tokens. As a result, I switched to positional trades and avoided those tokens. As they say, well planned is half done. I hope you will be able to develop an effective trading plan after watching this video. But a good plan is of no use if you don't develop the necessary knowledge for executing it well. We are building this Polynomial Academy series to ensure that you understand all other concepts equally well. So subscribe and press that bell icon to avoid missing out on other useful videos, and I'll see you in the next one.